Hi, everyone. Welcome to the Smallcap Discoveries one-on-one. Today on our call, we have Jerry Wimmer. Jerry is one of Canada's top stock pickers and runs an investing newsletter and website called investorfile.com. I'll now introduce our host, Paul Andriola, and let him take it from here.
Hey, thanks, Trevor. Really happy to have Jerry on board. I've known Jerry for a number of years now, and I like to say we play in the same sandbox. We're sort of looking for the same type of companies, and he's got a fantastic track record, and so we thought it'd make a lot of sense to bring him on board and have him tell us a little bit about what he does, how he got here, and sort of what to look forward to. So Jerry, thanks for taking some time with us. And why don't we start by having you just tell us who Jerry Wimmer is?
Okay, well, thank you for the invitation. I appreciate it. And Jerry Wimmer is you call me a stock picker, and I guess I'm a stock picker in a very defined space, in the microcap space. And I've had success there, and I continue to hope I'll have success, but I know some of the risks and pitfalls of investing in the small cap market, and it's probably because of my background where I learned a lot, stumbled a lot, and speaking of my background, I got interested in stocks not because of any family members. My family's an extended family weren't involved in the stock market at all, but it all comes back to a teacher, and it was a high school teacher when I took a course called The World of Business, and we touched on the stock market, and then from that day I kind of fell in love with the intricacies and the stock market. I remember him bringing in his old-looking laptop. Was it a pet computer? I don't want to date myself, and watching the stock ticker go across the top of the screen. So it caught my fancy, and I continued from high school. I was a semester at school, so I got out a half year early. In the period between the end of my semester and the beginning of university, which was about 9 months, I decided to further educate myself about the stock market, and I took the Canadian Securities course, which Paul would know, maybe it's renamed now, but is the baseline course to be a stockbroker or registered representative. So I was 18 years at the time, and it wasn't my pursuit to become a wealth advisor or stockbroker, how you ever want to call it. But it taught me a lot about the fundamental aspects and analyzing and learning about things that I needed to know if I was going to make investments more serious. During that period, I worked for a national brokerage firm in their trading department, so I got to see all the action and spend time on the then TSX floor, which was always very exciting. At that point, I did go to university and furthered education in business, microeconomics in undergrad, and then completed right after my MBA at the University of Toronto. And at that time, when I graduated in the early 90s, if maybe some of you recall, it's probably the worst time to come out with an MBA because Canada was in a really bad recession. And very few people were hiring. And I took a job just because not that much was available unless you wanted to go and work for a large consumer packaging company, but that wasn't my interest. So I took a job with a boutique merchant bank group that no longer exists today, but they provided a lot of funding for pre-IPO companies that were rolled into junior capital pools, which I guess no longer referred to that, but and so I got a lot of exposure to small companies, the small caps. I was an analyst there. And I noticed at that point that a lot of small companies that do go public lacked investor relations skills. So about 6 years after, I moved on and opened up my own boutique IR firm, providing IR services from the seat of my pants, I might add, to non-resource companies, and did that for 10 years and watched some of these companies grow. And lo and behold, 2008 and 2009 came, and which was probably one of the worst years ever for the stock market, and probably lost in those 2 years about almost all my clients who eventually went bankrupt, and kind of opened my eyes to realize, boy, small caps with debt and all those types of things, if you can't weather the unexpected, it's going to be a rough ride. And at that point, just a few years later, I thought, I've learned a lot about microcaps, what to do, what not to do, and lost money along the way. I thought, well, I'm going to put some of my knowledge to use. And this is 2010, 2011. Finally, in 2012, I launched the InvestorFile site as a way of a medium to expose my views on specific small cap companies that I think are worth investing in, which in fact I invested in. So I ate my own cooking. And it's from there I launched investorfile.com. And to this day, it still exists, and I've made 22 top ideas. And so far, they've worked out all well. Look, not everyone's going to work out, and if you play in the small cap space or micro cap space, you don't acknowledge that, you're not telling the truth. But so far, so good. InvestorFile has been a great medium to share my thoughts of the companies I've invested in. And to this day, InvestorFile has thousands of members who subscribe freely to be members to get blog alerts. Membership includes a lot of individual investors, mostly in Canada and the United States, many small cap fund managers, many small cap analysts and investment banking individuals. So it has pretty good exposure to the names that I like and the names that I invest in.
That's great. So maybe describe a little bit of your investing style. What do you look for in these micro caps, small caps?
Obviously, in investing style, I'm playing in a high-risk space. Anybody that's playing micro caps or small caps has to have high risk tolerance. But I wanted to kind of be a little different and maybe contrarian to the fact that I am not a momentum player, never have been, and I'm a value player. And people will say, well, how can you be a value player in the small cap space? You can be if you're very, very patient and you have high conviction in your picks. And I do have that, and patience and my individual research provide high conviction in what I'm talking about and investing in. So I use a bottom-up approach. I know the high-level macroeconomics, studied that, but I'm strictly a bottom-up investor, so I'm looking at individual companies at a very micro level. I'm cognizant of macro effects, but that's not where I begin, looking for investments. A very a bottom-up approach. Because I'm a value investor in the small cap space, it's vital to do your own research, because my best ideas are originated from me, not from somebody else. Because if somebody else is telling about XYZ stock, I can tell you there's no value left in the stock because other people have already discovered it, be it retail investors or maybe institutions, and therefore that stock becomes a high growth, high value stock. So I always like to think that I put in the research and time, and I credit my best ideas to what I find, not what find me. And the second philosophy is I'm a very patient investor. I'm willing to wait, and I think, to be honest, I think a lot of investors make that mistake in the micro cap space. They never match the right investment horizon to when they're investing in small cap stocks. I'm willing to wait 2, 3, 4, 5, 6 years, even longer, with my winners. Patience is key, in my opinion, when you're investing in small micro cap stocks. So by not being a momentum investor, I've got to do a lot of research to find the names that I think provide value. I only deal in non-resource stocks, so I don't have commodity pricing issues, those types of names that I attempt to find are not suited to find through filters. I get that question asked almost once a week in an email of members or anybody who follows me. Says, what filters do you use to find your stocks? And I said, well, I don't use filters. I mean, filters for me, a value player, have no meaning, because by the time I discover, or the filter is telling me that this company's EBITDA positive or has 3 great quarters, it is discovered by anyone else. And for a value investor, it becomes way too rich for me. So it is, when I say homework, and I know, Paul, you can probably appreciate this, it's really going through a whole bunch of MD&As and reading them. And they're a great tool for investors to read. They're found on CDAR. I'm sure a lot of your followers know the MD&A and its value. And by reading the MD&A of companies that you have discovered and kind of following them for several quarters and matching what the CEO does and what he says in the MD&A, and watching them, come to fruition, gives you the validity and the comfort that the company is starting to perform the way you expect. Another great way is that I do look at press releases all the time. I subscribe, I guess I'll be plugging Stockwatch. For $5 a month, they put a great service out. Nowadays, press releases are kind of released through maybe 6, 7, or 8 different press release services. And Stockwatch for $5 a month consolidates every press release ever written by every Canadian and US company right in front of you. And I scour those every single day, and maybe I see a press release of a company I'm not familiar with, and oh, it looks like they did this. It goes onto my watch screen. I go into the MD&A, and there starts the connection to the company. So I suggest investors, if they're really serious in the microcap space, and they're not necessarily playing momentum, that the MD&A on any company you come interested is a must to read and learn about as a first step to identifying companies that you want to watch. And that's where I really get all my ideas.
Yeah, very similar to the way we operate. So it's good to know that other smart guys are doing what we're doing. So give me a sense of the universe you operate in. Do you look at U.S. companies? Do you look internationally? And then sort of what's your size limit that you tend to look at?
Yeah, I swim down really low in the microcaps, it's because I do think that most microcaps that have sales above 20 or 25 million are probably already discovered. I like all my names to get there and then some, but usually if they're of that scale, most likely they're discovered. So I'm swimming down in the sub 10 million most of the time to find my names. I look at right now at Canadian names, because quite frankly, it's the disclosures are fantastic. From a disclosure aspect, I think it's second to none. And just because they're in Canada listed, if I would look at all my investments made to date, the majority of their business is in the United States and maybe abroad. So just because they're a Canadian company or Canadian listed, that doesn't mean they're selling into the US markets. So where it's listed or where the company's formed is not really material to me. I do say that I tend to stay in North America markets, and I tend to prefer companies that sell to the North American market or some other Western economies, because I understand better understanding of the way some other economies do business. I've always been, and not to say you can't do well with companies selling to China, but I find it a risk tolerance or risk factor selling outside US or Canada or some European Western economies is kind of a risk factor that I don't want to take.
Why don't we talk a little bit about, a little more specific about what you look for? So let's see you're reading an MD&A, you're reading a set of financials or press release. What gets you excited? What do you need to see to say, okay, this is something I want to dig deeper into?
Yeah. So I'm open up to any type of business except resource. Yeah. Not too much pharmaceutical either, just because of the risk factors sometimes associated with those or my lack of experience in that space. So I look for businesses that, there's several. I mean, there is the small business that maybe at 5 million sales, whose operating leverage hasn't shown through yet because sales haven't gone to 7 or 8 million. but you can see that trend with their margins that, you know, if they add 10 or 20% sales over the next 2 years, they will flip from negative EBITDA to positive EBITDA. I also play a pretty strict rule about investing companies with debt, especially bank debt. I try to avoid, in most cases, maybe I'm super conservative, but most of the small caps or micro caps that I put on the investor file top ideas list had no debt. And in many cases, they were cash rich, believe it or not. So the balance sheet is huge as my safety net. Because I have low risk tolerance within the micro cap space, I can't take on names that have debt, especially bank debt. There are some that can have debt which is owned by a major shareholder or things like that. There I can have some latitude in. But avoiding companies with debt, looking at companies that are straddling the EBITDA positive, negative to positive, are some of the factors I'm really key on. Sometimes this comes as a turnaround. I've had many successful companies that I bought because they were a turnaround process. Sangoma Technologies was a turnaround stock, and where a different management team came in and had to fix things up, you know, change the business model. So turnarounds can be very attractive. In saying that, another point that I look for closely is capital structure. And I think a lot of small cap investors who don't have a business background or securities background understand capital structure well enough when they make their investment decisions. And so outstanding stock, adjusting for convertible debt or other dilutive factors are something that I stay away from as much as possible. So I can kind of know myself as this company progresses, what the capital structure will look like, and therefore, how will I get my return as a shareholder? And so I tend to avoid companies that have, you know, hundreds of millions of shares outstanding. Those ones that I look at, I hope one day they consolidate their shares. And when they do, often they drift back a bit, then they become very attractive investment opportunities. And several of the InvestorVal top ideas were such companies that after consolidating the stock and changing management, they became some of my best ideas ever.
So you mentioned a couple of areas you stay away from. Obviously, resources, you stay away from there, and you tend to shy a little bit away from the pharmaceutical. But do you find that you're finding more companies in certain industries or certain sectors of the economy?
Well, obviously in the high-tech space, it's, if I look at most of my names, there are in the high-tech space, software or SaaS space. It's not so much a factor of the space. It's, for me, it's understanding their business model. And in many cases, I like the simplicity of the business as a way of looking at companies with a simple business to understand. And that might not be the product itself, but it's more their sales cycle. To look at how they sell, how quickly they can sell, what's the evaluation process, can they have multiple customers in different sectors? So, you know, those are the things I really key in. Of course, the product has to be a good product, and there has to be demand for it. And obviously, you know, the sales should tell you there's a demand for it. But companies that have multiple customers that are not project-based, obviously reoccurring revenues. I mean, you know, these are some of the sweet things that I really get attracted to. Obviously, you can't, everyone doesn't have all those properties. But if I can understand their business, or if I know that their sales cycle is not complicated, I have a lot more comfort, and therefore a much easier to become an investor in such companies.
You know, a question that comes up a lot when I talk to investors is sort of portfolio concentration, or, you know, how do you manage? You've got a number of ideas. How do you manage, call it your portfolio or your you know, your group of companies as far as investments?
Of course, I have a watch list of many companies, and I could be watching companies for 2, 3, 4 years until I become interested in them. You know, I have made 22 top ideas, and to be honest, I've held on to all of them. Now, 9 of those 22 have been bought out. So it's forced liquidation, which is probably a very good thing in some ways. Sometimes the takeout price wasn't as attractive as I would like. You know, I only invest in my best ideas. So I have high conviction. So diversification is a function of, if I can find a best idea, I'm going to invest in it. So I don't have too much problem of investing in many names if I consider them all best ideas. Now, there is some portfolio rebalancing that has to be done because, you know, some of your names do get ahead of themselves and they're trading it just because they become recognized instantly. And you don't want any one name to become, you know, 60% of your portfolio. So you might trim the stock off for portfolio reasons, or quite frankly, for tax reasons. You do that too. So my concentration really varies quite a bit, but I don't like selling winners. And that's because I have the conviction in what I've learned about the company. So I'll hang on them quite a long time. And for the most part, it's proved the right decision.
So, okay, let's talk a little bit more about selling. So, you know, you've had a number of companies that have been bought out. That's obviously a, you know, forced liquidation. But what if something isn't performing or isn't a winner? When do you look at selling your loser or something that's not performing?
It's a good question. And, you know, I guess when I buy the names or the stocks that I invest in them, I look at, okay, I have to expect the unexpected here. Buying a small cap or micro cap stock, you have to expect the unexpected. So, you know, if I buy wisely, if I buy companies that don't have debt and lots of cash, if for some reason something happens unexpectedly, and COVID's been a great reason, my names can weather the downturn because first, I bought them at a very low multiple, and even during the downturn, the stock rarely comes down to my cost base. And secondly, and I should put a third point in there, secondly, these companies are under leveraged or have no leverage or cash rich, so they're not at a mercy to raise more money at the worst time and obviously dilute themselves. And the third point, in many cases, I hope to think I understand the management team and that they're prudent enough that they position themselves to weather tough times. So when you ask, when do I sell? Obviously, if a company management philosophy changes or management change, or if they become too highly leveraged, and you know, we can discuss what leverage I would tolerate or not, I really have been in a position that I need to sell my names. I'm a patient investor. B, rarely the stock retests my cost base. So yeah, I missed an opportunity, didn't expect oil prices to crash, stock is off, but I'm still 3 times up on the name and the company has a great balance sheet, it's cash rich, I'll wait it out. So that's my answer for selling, and maybe it's not the best answer, but I try to position my portfolio not to be put in a position where I have to make a rash decision about selling.
And does your company ever get too expensive? Like, do you ever say, okay, this is, you know, it was a $10 million company when I found it, it's a $300 million market cap, you know, I'm going to move to greener pastures?
It hasn't yet, because most of my names are still widening their investor audience. So there's a different level of institutional investors that are still coming into the stock as the market cap rises, or if they list on a different exchange. So it hasn't happened yet. Some names were taken out, so I never got to that point. Obviously, you know, if the multiples do, you know, become insane when things are trading at 20 times the revenues and, you know, 200 times earnings, you know, I would have to revisit my thought process on that. So I'm cognizant about it, but because I'm investing in micro caps and the companies have matured to become small caps, and hopefully they mature to become mid caps, that the valuation, albeit much better today than it was when I started, there's still a lot of opportunity for new investors to enter the stock, new investors to enter the stock, I should say.
Perfect. Should we talk about some of your favorite ideas?
Well, you can talk about my favorite ideas. I'm an open book because everything I invest in is written on investorfile.com, and the reasons for my investment are. I just want to be clear to your listeners here that I eat my own cooking. So what I write about, I invest in, and that's all. These companies I have no other relationship with. I'm purely a shareholder in them. So I'm swimming in the same ocean. Against the current sometimes, or with the current. So,
and with the sharks, yeah.
With the sharks too, yeah. So I'm very much an open book when it comes to my investments, rightly or wrongly.
Oh, perfect. Well, I respect that. I got a lot of time for guys that do just that. So your money's at stake as much as anybody else's. So I like that. Well, why don't let's talk about some of your ideas. Maybe let's talk to some of your sort of big winners and maybe some that didn't work out so well, and then we'll talk about some new ideas right now.
Yeah. Well, I mean, my first large winner was a company that was taken out was Rdm Corp. It was the second top idea that I ever wrote about for investorfile.com. And what attracted me to that company back in 2012, the company stock was trading basically for its cash value. And it was just flipping over to EBITDA positive. It was a turnaround story, new management team. Obviously, I speak to management before I invest or invest a full position. And I got a comfort level that during the turnaround process that he was, saying what he was doing and doing what he says. So RDM was a company I invested in at 83, a little over 80 cents. And 5 years later, sold out for $5.45. Of course, institutional investors recognized, this is a good idea. The company never attracted much analyst attention or investment banking attention because it was so cash rich. It's amazing, and I know I'm straying aside here, but there's so many times that I shake my head that there's no attention given to some of these companies that are sitting with so much cash on the book. They're getting no attention because obviously investment bankers can't make any fees off these companies.
Exactly.
These are great stories. And RDM was a perfect example of that. So that was a company very early on that identified as a value-driven growth company and really lived up to its expectations. Very tight float, and eventually was sold out at $5.45 a year a share, which was obviously a very, very big gain from when I bought it on. I like 10 baggers. I like, these stocks, but I'd rather be in a position to be right more often than I'm wrong. And if I'm right with, 2, 3 baggers, a whole plethora of them, I'm just as happy because 10 baggers are hard. I've had 1 or 2, but they're very hard to come by. And I'm not prepared to make 10 investments to lose on 9 and to win on 1. I rather, try to find the ones where I can make 3 times my money. And RDM, which was more than 3 times, really was a perfect example of that.
Yeah, it's amazing. I think we share the same sort of idea in that, having a high degree conviction is more important than having a chance at a 10 bagger, 20 bagger, right? Yeah, so good. No, I completely agree with you there. What do we, talk about one that didn't work out and maybe why you think it didn't work out?
The company that didn't work out would be Procera Inc. And, it was a company that was value driven at the time, had some cash. I invested at 9 cents. Now the stock went as high as 33 cents. So, it did very well. I sold stock there, but ultimately was sold out for 12 cents a share. So slowly above in a takeout just last year. And quite frankly, and I don't hide anything when it comes to my views, it was poor management execution, where management did not say what they're going to do. I mean, they said what they're going to do and they never delivered. And I know there were some challenges in the business that maybe would have, that were part of the reason why, but management started to just not deliver and not deliver and not deliver. So there's an example of an interesting business. I still made money on it, but really didn't work out. And the company was sold for, small premium to my initial entry price.
It's great when your losers still make money. You know.
Yeah, I mean,
Yeah.
it's maybe it's some luck, maybe it's just patience in terms of when I enter a stock. The cost base is pretty low,
Yeah.
and that's where my risk tolerance is lower than maybe others within the microcap space.
No, good for you. Why don't we talk about some of your sort of your current ideas, some that you think deserve a little bit more attention, some that you like.
Balance sheet at the time, but who a management who I saw and who I met with that really delivered on its vision. A team that was serious about turning the company around, delivering on a recurring revenue business model, and since has augmented their business model with several acquisitions, very successful acquisitions, might add, and has raised over $150 million, and that Sangoma Technologies. I think still today, obviously the company raised another $80 million over the summer, $2.30. But this company has deployed capital on very smart acquisitions, and more importantly, it integrated those acquisitions, because that's more important. And I expect the company to do the same, this time even bigger and maybe better, given that they have raised $80 million and are not highly leveraged. Still a company largely undiscovered. I know the stock is raised as high as $290 a share. It's trading around $250 a share. But I think there's lots of opportunity to invest in Sangoma. It's in the right space in the unified communication space, which people not familiar with the stock, unified communications basically consolidates a enterprise's communication services, be it email, telephone, obviously remote, and they provide that largely as a service. So it makes it very easy for a company to subscribe for a service that provides them with a communications second to none. And COVID has actually maybe given Sangoma a little bit of a tailwind, given how many businesses need to move to a remote communications environment, and they can provide that seamlessly to their customers, either on premise or even better, in the cloud. And I think investors should keep an eye on Sangoma as their reoccurring revenue base now is over, I think it's close to 60% now. The EBITDA margins are rising, the company is growing, and I think the multiple of the stock is yet to be re-rated. It has already done a re-rating because there's been, select small cap fund managers that have entered the stock. But as you know, as the market cap continues to rise, other institutional investors will come into the stock. I firmly believe with the next acquisition that Sangoma makes, and they have a track record of making good acquisitions, that'll be the biggest and better, and the stock will again re-rate and the market cap will continue to rise. I do think the company will list on the TSX. These are my thoughts. Management hasn't told me that. Sometime next year. And I think it has a great position to become a TSX small cap index stock once it does that. And as you know, Paul, when you're added to an index, all the ETFs, are going to have to invest in it. And then again, the multiples will continue to go up. So despite Sangoma being up for investor file, it's up, 1,200%, it could be more. There's still a lot of value. And I think small cap, micro cap investors, individual investors should still pay lots of attention to Sangoma, and maybe even more so than ever, because I do think they're on the verge of making another acquisition, maybe this calendar year.
Yeah. Yeah. It's Bill. Bill's the CEO.
Bill Wignall, yeah.
That's right. Yeah. I remember we actually had him at one of our conferences we did a couple of years ago.
Yeah.
Very impressive. Definitely. Yeah, he's executed, and it's always encouraging to see guys like that really make it work. So
When I met Bill first, after I obviously I spoke to him, but met him personally. It's a Toronto, a market-based company just in the suburbs of Toronto. So I had the opportunity to meet him at his offices, and we sat in his boardroom. And at the time, his AGMs were just me and one other shareholder. That has changed quite a bit. And he would say, Jerry, look, here's what I'm doing. I want to turn this company from a hardware company to a reoccurring revenue model company. And probably he said that before it was fashionable to say that.
Yep.
And he did that internally and largely also through acquisitions. The benefits aren't obvious at the beginning, because when you go from hardware to a reoccurring revenue model, there's a lag, because the revenue doesn't hit you; it hits you over time. But over time, the revenue start mounting, but your EBITDA margins, just increase at a great rate too. And Sangoma has proven that, where they're hitting close to 20% margins, maybe even higher today, and that's pretty good return on a revenue base which is growing rapidly.
Perfect example of the right kind of micro cap. It goes from completely undiscovered to slowly getting discovered, and you get that multiple increase. So fantastic. So you mentioned two other ones. Which other ones? I think I know one. But
I'm going to go to the other spectrum, and I know it's a company that you're familiar with, maybe more lately than as I am, and that's AirIQ Inc. And AirIQ Inc. I recommended, it must be 5 years ago now, at 8 cents a share, and took a position down at those levels, below 8 cents to be honest. Haven't sold the share since, and the company obviously is catching the attention of individual investors. Partially, your group of investors have taken a close look, others too, and it's a company that is a turnaround story, which was a high-flying stock. Never owned it, but they raised a lot of money and lost a lot of money. And new management team came in, and new board came in. Also a board member that took a major position in the stock, so they're all aligned. And it took some time, but this company, off a very small revenue base and prudent management, he's delivered a positive bottom line, EBITDA and EPS. That's on 5 million sales, and they did it on 4 million sales. And now you kind of think, well, God, if they can deliver on profits on 5 million, what can they do at maybe 10 million and 15 million? And I think you're starting to see that as the company's, it's a telematics company, as you know, is broadening its product portfolio and starting to hit new verticals, outside of traditional asset management on vehicles. Recently they announced a vertical when it comes to container tracking, because they added a new product portfolio of tags that are battery powered. They also added a new camera option that provides a telematics option that includes analyzing driver analytics for delivery truck companies. So I like what AirIQ is doing. It's a very small company, generating a lot of cash, lots of reoccurring revenue that continue to build. Today they have over 2 million in cash, and if anybody had a chance to look at their recent presentation, their AGM presentation, or had a chance to listen to their AGM, I think they're going to use some of that cash in some strategic acquisitions. They've hired somebody, consultant, to do that for them and to help identify. So AirIQ is a great story, and when a company at 5 million can make money and has 2 million in cash and is generating cash, there's a lot of leverage there that this company can really grow shareholder value. And they're starting to demonstrate that, and they're starting to attract attention. And today the stock is up at 37 cents, and I think it has still room to grow as they continue to deliver.
I couldn't agree with you more. I mean, do you notice that a lot of these companies, they have a history of having had sort of maybe an IPO where they get all sorts of investors excited, and the company's sort of too immature to really be successful, but it takes like 5 or 10 years. They get orphaned, guys like you or me start finding these things, and then they actually build a business, right?
I love orphan companies.
So do I. Yeah.
And I know you too.
Yeah.
You know, and I wrote a blog article about, you know, some of the principles, important principles to and for InvestorFi when we come to picking stocks. And one of them is look at the ignored. I love the ignored because for a guy that invests at the value end in the microcap range, you're going to find value when companies are ignored. Interesting enough is not all ignored companies are terrible companies. They're, like I said, they're often cash-rich companies that just, you know, at that market cap don't attract attention because they don't need to raise money. So AirIQ, I think, was the company it was ignored for good reasons because previous management, you know, obviously didn't execute. The company lost a lot of money. That's a company also that his stock got, you know, consolidated down to, you know, 30 million shares. They haven't issued another share since. You know, gotta love that.
Absolutely.
I always say to investors, I say, you know, it's very destructive, and I understand why some companies do it. But if you can have a business model where you can generate profits, you know, at 5 million revenues, you're saving all that dilution that you need to make at very unattractive shares, and that comes back. You know, AirIQ, you know, at 5 million sales, never diluted themselves. You know, here we are, 29 million shares outstanding. You know, companies earning, you know, 2 cents. You know, this year could do 3 to 4 cents. You know, at 10 times that's a 40-cent stock. So there's a lot of upside there in a stock that didn't dilute itself because it could generate profits very early in its business development or re-business development.
Yeah. No, exactly. That's and you sort of get paid to wait too. If these companies are profitable and they don't have to go and refinance, you know, sooner or later someone's got to give, but you actually get paid to wait. Okay, so you mentioned a third one. What's the other one you got?
So the third one is also a larger company, but believe it or not, a company that is undiscovered, and probably for good reason because it's kind of gone through a couple go-arounds, and that's Avante Logic. And Avante Logic provides security services in two verticals, a little different than it did several years ago when I first invested in it. They provide high-end security services for people looking for premium security for homes and businesses. This is not your you know, your $30 a month security, you know, like I have. This is your $200 a month where you have video analytics, or whereas there's a $10 million house or $5 million home, or when security is needed for various reasons. They also recently are in the verticals of commercial security, providing commercial security service to larger institutions and guard service. And why I say this company has kind of gone around twice, there has been a management change, and not necessarily for the reasons that the previous management did a bad job, but a new team came in and saw a different vision to grow this company and grow it outside its traditional verticals of home security. And this company has made Avante Logic, symbol XX on the venture exchange, has made several acquisitions, and these acquisitions have proven to take time to integrate. Maybe the integration process was a little longer than management expected. Now, the current management team has experience in this space, so I fully, and has success in this space, has sold large companies out in this space. So I fully believe that they'll get there. And I think there's some evidence they are getting there now as they move from EBITDA negative to EBITDA positive. And what's interesting about this is the valuation, in my opinion, is very cheap, given a sales multiple level. The company's trading at 21% of their annual sales. And I wouldn't stress that, but their 80% of the annual sales are now deemed reoccurring from monitoring fees or from long-term multi-contracts with corporate customers. So when you have a company that's trading at 20% sales on a base of 75 million sales, that largely is reoccurring, and they're flipping from negative EBITDA to positive EBITDA, obviously we have to see consistent momentum. You're going to have a re-rating of that stock to at least 1x sales, at least in my opinion. And you can do the math. A company with 21 million shares outstanding, or 26 fully diluted, at 1x its current sales, this is a $3 stock. But I understand it still needs to prove that its EBITDA momentum is progressing from quarter to quarter. And I think there's some evidence it's doing that now. And therefore, I recently wrote a blog post on the company, or more specifically, a blog post about how I like when two value indicators show up strongly. And that's companies trading at low price to sales ratios, which Avante is, and at companies that start showing EBITDA momentum. And I wrote the same blog post 1 year ago, almost to the day, and I highlighted Sangoma and AirIQ as two companies that are experiencing that same phenomena. I think at the time, Sangoma was trading for less than 1x sales, and its EBITDA momentum was insane. At the same time, AirIQ, maybe not as attractive on the price sales multiple, but bottom line EBITDA performance and EPS performance was trending in the right direction. And both those stocks have reacted very nice since that blog post. So I'm hopeful the same for Avante. And the only advantage with Avante is that you have a very large revenue base, already 70 million. And which I think once profitability can be sustainable, will probably attract institutional investors quicker. And I think at that point, there'll be a re-rating on the stock. And I expect this company sometime in the future, not in the near future, will make a couple acquisitions, probably go out to market, raise a few dollars or maybe more. They have a tight share float, management, and owns 30% of the stock. So I think there's a lot of upside. If I'm correct in assuming that EBITDA momentum will continue, I think there's some evidence that it will, but time will tell. And maybe when you interview me again, you can ask me the same question.
Exactly. We'll check in a year from now and see if you can hit 3 for 3.
Yeah.
Sure. Avante is a company that we've known for years. Yes. Actually, we recommended at one point. So definitely, like and understand what they've got going on there. So traditionally, what do you see as the catalyst that usually like these things are obscure until something happens? What do you usually see as the catalyst that bring attention to these companies?
It's not so much of a catalyst. It's more of operating leverage. And I think that's the catalyst in itself that I like to invest in. Companies that can prove that they can make money at X sales. And I know as their sales grow, that their operating leverage will grow too. And that delivers to the bottom line. So I look for companies that I can understand, and there's the ability internally and through acquisition that there can be margin expansion, EBITDA margin expansion. And I think for me, that's the biggest catalyst. I'll give you an example. If Avante, who is EBITDA 3% margin right now, can get to its stated 10% goal, you're going to have a strong re-rating of the stock. So that's the catalyst that I would probably key in most. I try to stay away from predicting takeovers, albeit I like that, or predicting big contracts, because these are very unpredictable and they can take a lot of time. So I rather understand the operating leverage and how a company can, achieve more operating leverage as the catalyst that I think would increase the share value over the longer term.
Fantastic. Well, listen, thank you for those three ideas. I think certainly we know them all, and
I have more ideas.
What's that? You got more? Well, let's. We got some time.
So. I'm just going to point out, and this is a little difficult, and it's funny, different because I just talked about not catalysts. And here's a company that maybe there are some catalysts going to drive the stock, and that's Ecosynthetic.
Okay.
CEO of Toronto.
Yep.
And it's a renewable energy company that provides, green chemicals to replace chemicals, oil-based chemicals or fossil fuel chemicals used today. And I've been watching the company for a while, and people ask, geez, you recommend a stock right at the height of COVID. This is back in April when ECO, which is listed on Toronto, symbol, I recommended it at $1.70 a share. I'd been accumulating the stock when it kind of came down to $1.1650. I've been watching the company for a lot of time. I just thought it was an attractive entry point. Now, one reason I could do that with conviction, first of all, that Ecosynthetic, which reports in US dollars, had $40 million of cash on the books and no debt. 40 million. I said, wow, that's a lot of downside protection. But a company that today breaks even in its current business, but I think has a couple of catalysts that will be forthcoming soon for the company that will re-rate the stock. And as I said, they're a renewable chemical company. They provide chemicals and formulations that are used in making certain products, but they can provide a green alternative that provide the same properties needed that fossil fuel inputs have provided. And a couple of examples is hair fixative products. Hair gels and mousses are made, with petroleum-based products and chemicals. And there's a movement to hair products by some of the biggest names out there that are going to be deemed green or fossil fuel free. And lo and behold, Ecosynthetic will be a supplier to such companies, chemical companies who sell to the major brands, so they can market green hair fixative products, which is high margin business. They also supply chemicals that provide adhesives, a green alternative to adhesives that are used in particle boards. I'm sure in your house, and I know in my house, I have a lot of particle board in many pieces of furniture. Quite frankly, office furniture is largely made of particle board. And unfortunately, particle boards is made with some very harmful chemicals. The chemicals are needed at this point as adhesives to bind the wood chips in order to form the particle boards. And Ecosynthetic's been working very closely with a very large retailer, which they haven't named, but I can somehow name just the fact that I read on the website of this large retailer named IKEA that it's going to be moving to a green-based solution for its particle board furniture.
Yeah.
Well, these are some of the catalysts that I think are coming shortly for a company like Ecosynthetic in terms of expanding their verticals in particle board furniture, in hair fixative products that I think will be a catalyst for the company, even though it has $40 million in cash still, and only has, been buying back their shares at these levels. I think it's 56 million shares outstanding right now.
Okay.
And obviously, the company's debt free.
Yeah. No, I was going to ask you about the number of shares outstanding, but you just answered that. That's perfect.
Yeah.
Listen, I mean, you gave us some great ideas. We get a lot of listeners that are, haven't spent as many years in the business as we have. If let's sort of end on any kind of big piece of advice or takeaway that some sort of newer investors should really understand about the space that we operate in. The Canadian non-resource microcap space. What's that one piece of advice you think everybody should walk away from, or what?
I have several pieces actually, I think it's very fashionable now to be a momentum investor, and I think in the small cap or micro cap space, you can make money, being a momentum investor, but the longer you go, you probably lose more than you're going to make, because momentum works both ways. So people who invest in small micro cap stocks, I think, should have a longer investment horizon, and therefore I would pay less attention to momentum and pay more attention to the business that you're investing in and the capital structure of that business you're investing in. And I think longer term, you'll be a much more successful investor. I think long-term microcap investors and such as yourself, survive in this business because they're not playing momentum. They're playing long-term value, even though it's at a space with higher risk tolerance. So the second piece of advice is I would try to do your own homework, understand the business, and probably, listen a little less to other people, because often when you hear stories from other people, the stock's valuation is already out of hand, and you're probably paying way too much for the stock, and you have a big chance of getting hurt and maybe kind of never wanting to play small cap stocks again. So check your investment horizon. Be careful who you listen to. I mean, there are people that have invested with patience and conviction and don't over promote. They tell it as it is. I listen to those people, and I pay attention to capital structure, and I would check your investment horizon. And if your investment horizon is 1 month, 3 months, 4 months, you're gambling. You're not investing. And in the small cap space, particularly the micro cap space, that can really come back to bite you. Trust me, I know.
I think we both know. We've been around long enough. Yeah, definitely. Well, listen, Jerry, thank you so much. If somebody wants to get more information on InvestorFile, give us the website again, and maybe your email or some sort of contact info that they can get a hold of you.
Sure. InvestorFile.com, as it sounds, all one word. Anybody can subscribe to it and get my email alerts first in terms of new blog posts. It's free, so stick in your email. There are thousands of members right now, and I have very good feedback on InvestorFile.com. All my thoughts are on that website, in terms of my investments, what I think about the stocks. So I am an open book. Anybody can send me an email. I respond to all emails. gwimmer@investorfile.com. You can send me stock suggestions, but it's unlikely, especially in Canada, I would know the name already. And like I said, I do think my best ideas are the ones that I find that don't find me. That again, you can send me your stocks suggestions. I'm also have active following on Twitter. IF stands for InvestorFile. IF Jerry Wimmer is my Twitter handle that I use. So subscribe to Twitter, and I send tweets out, almost every day. Sometimes just forwarding news releases of some of my top ideas. Sometimes shouting out a new high or a new high close for my ideas, or sometimes just making a comment here and there of a recent investor, a press release. I don't comment on every press release, but sometimes ones that are particularly interesting. I like to put a note here and there, and I often post, when available, analyst ratings on the names that cover. So that's also a good source to kind of follow what I do. Subscribe to all of them, or read my website at your leisure. You choose what best serves yourself.
Perfect. Jerry Wimmer, thank you so much. Great having you on with us today. It'd be great to check in at a later date. This has been fun. I appreciate it.
I thank you for inviting me, and I had a lot of fun too. And shout out to Small Cap Discoveries for doing a great job in educating people right when it comes to investing into microcap non-resource stocks.
Awesome. Appreciate it. Listen, Trevor, I'm going to hand it over to you.
Awesome. Thanks, Paul. And again, Jerry, on the behalf of Small Cap Discoveries, thanks for coming in today to share a few notes on your history and how you invest. And we're looking forward to your next pick.
Thank you very much. And good, and stay well to everybody, Paul and Trevor and everybody out there watching this video. Be well.
Thank you, Jerry.
Thank you.